Hello traders, Gary Wagner here. Just about 12 noon in Honolulu, 6 o'clock in New York. It is Thursday, January 10th, 2018, and this is the daily report for gold and silver. We do have declines in gold, silver, platinum today, with palladium bucking the trend and trading higher on the day. First to gold, it is closed down $4.90, and basis most active February is currently sitting at $12.8710. We've got silver also trading off, but trading off by almost 0.9% at $15.60. Palladium, the only thing bucking the trend, up about $8 on the day at $12.77 and getting closer and closer to parity with gold pricing. Now, the dollar was stronger today after being weaker yesterday. We'll talk about that in detail as we pull up our technical studies, but today's pricing is 95.14 after adding a 35-point gain on the day. Now, we do have a risk-on environment with U.S. equities staging a pretty nice rally, actually trading up for the last 5 consecutive days. Dow back over 24,000 at 24,001.92 after adding a 122-point gain on the day. NASDAQ Composite gaining about 0.4% at 69.86, and the Standard & Poor's gaining about 0.45% at 25.96. Traders, no doubt, we did see a moderate decline in gold pricing today, but overall, in terms of the characteristics of price change lately, I think the most important characteristic has been the oscillation on a daily basis between a green candle and a red candle. Obviously, the green candle meaning that it closed higher than it opened, and a red candle during days in which it closed below its opening price. And so here we have Thursday, today's move, Wednesday, Tuesday, Monday, and then this large range on Friday. And what we can see is that although the market has been oscillating between green and red, green and red, green and red over the last 6 days, we have seen basically a compression in price, which I find most interesting. And we're going to look at it today first through the eyes of dollar strength or weakness, because it has been dollar strength or weakness that has been the largest mover in terms of gold pricing recently. Traders, we are looking at a daily chart of the dollar index. We can easily see that the market itself firmed up a little bit today, up about 35 points. That is this green candle here. It does form a 2-day pattern called a piercing line, but what is more interesting to me is that same occurrence of the oscillation between positive and negative days, or higher closes and lower closes, is quite evident in the dollar also. We had a higher close today. Yesterday, Wednesday, we had a lower close. On Tuesday, we had a higher close. And then, of course, on Monday, we had a lower close. So we've gone red, green, and that's occurring after the move that we saw on Friday. Now, whereas gold had a large range, but also a large change, dynamic change in terms of price, we had this large range on Friday in the dollar index, but it closed pretty much in the same area where it opened, and that gives you that doji candle. We also talked about the fact that what has been interesting this week is beginning on Monday, the dollar index opened just below its 100-day moving average and then closed even more sufficiently below that. We've seen a decline in price over the week, but we are now approaching this 200-day moving average, and at least for the last 2 days, that seems to have been an indication, at least on a technical basis, that we're looking at some support in the market. However, in order to really take the noise away, what we want to do then, of course, is to convert our daily into a weekly. And what we can see when we do that, and let's go ahead and blow this up a little bit, is that over the last 4 trading weeks, we have red candles, meaning that the market closed below its opening price on Monday. We've got about the same range as we saw a couple of weeks ago. And last week, again, we had that doji candle on a weekly. And so what we can say is that really since the middle of December, when we had the dollar index trade as high as 97.50, overall, In terms of a long-term look at the market, we have seen a dramatic decline in the dollar index, and I do expect that to continue. Now, how does that translate over into gold pricing? And let's go ahead and pull up our gold chart. And traders, the chart that I do want to use for the analysis is going to be a shorter term chart than I typically use. We're using a 240-minute chart, meaning that each candlestick represents 4 hours in trading. We can easily see if we go back to the beginning of the year that in essence, this year's trading opened at about 1283 and then hit this top just above 1300. Over the last 24 hours, we've had another real attempt at it, although we've had a lower high. In the same way, when we look at Friday's range, and that's this big spread right here, we can see that the lows this year have been 1278, and that was the low on Friday itself, and it occurred in the evening, which is the overseas session before New York opened. And what we can see in terms of the lows in the market, we have had a series of higher lows. So when you have higher lows and lower highs, that's obviously a range that is compressing. We are now closer to the bottom end of the range than the top, but my sense is that if we look at the price point at the bottom, we could see gold pricing trade as low as about 83. In other words, come down to the bottom of this. And if all is holding true, we should get an uptick. And depending on when we reach the apex, at some point we're either going to break hard to the upside or break to the downside. As I am on record of saying, in this kind of a compression triangle, typically analysts look for the market to basically move to the prevalent trend direction. And in the case of gold, the prevalent trend direction has to be up. We've seen this market move higher on a consistent basis back to mid-November when the market was trading, roughly at 1,200. We have seen this market move from about 1,200 to 1,300, which represents a rally of approximately $100. And the reason that that's so important, that 100, is rallies in gold, if we look at historical data, a good rally tends to be about $100, and an exceptional rally tends to be anywhere between $140 and $160. So if we only get a good rally here, we could be looking at somewhat of a short-term top, the failure at 1,300. So we're going to have to see, because this, to me, is a very critical point as to whether or not we are going to see on a short-term basis effectively a top form and lower pricing. In other words, a break to the downside. If that is the case, we will want to do our fib retracement from these lows at 1,200 to these highs at 1,300, which I have just put in to determine where, in fact, this retracement could go to. Because even in a bullish mode, we're going to have periods of upticks and then corrective periods that have to be shorter in terms of price move than the upticks. That's the definition of a bullish market. So if, in fact, we see this market have some weakness and begin to trade lower, we could trade as low as, call it 1260. That would be the 0.38% retracement. If it's a shallow retracement, a deep retracement could take us as low as 1236. However, if we still have steam in this particular rally, because I think overall I'm still bullish, I'm looking at more of the minor moves in the market, I could look to see this market track easily as high as 1325 or higher. We know that we also have some resistance at 1312 and then again at 1325. But I really believe that the key as to whether or not this rally is over or if it has more steam is how it reacts in this compression triangle. We have moved our stops up. We're going to watch this market carefully and then act accordingly. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.